December 30th, 2025. While most people were focused on holiday plans and New Year celebrations, China's Ministry of Commerce just dropped a bombshell that is about to reshape global silver markets in ways most investors don't understand yet. And here's what should terrify you. This isn't about tomorrow's price movement. This is about a supply structure that has been quietly collapsing for 5 years, finally reaching the breaking point where policy meets physics. The announcement itself sounds bureaucratic, boring even. China named 44 companies approved to export silver during 2026 and 2027. Sounds like routine government paperwork, right? Except here's what that number actually means. Out of the hundreds of Chinese silver exporters that existed just months ago, only 44 made the cut. The rest? Locked out. Finished. Unable to export a single ounce to global markets. But the real story isn't the number of companies. It's what they must prove to qualify. Annual production capacity of at least 80 tons of silver. Credit lines of around $30 million. These aren't just requirements. These are walls specifically designed to exclude everyone except state-approved giants. And when you control between 60 to 70% of the world's refined silver supply, and you suddenly restrict which companies can export it, you're not managing resources, you're weaponizing scarcity. Now, before you think this is just another China story, another geopolitical headline that doesn't affect your daily life, let me show you exactly where this goes. Because what's happening right now with silver export controls is following a pattern we've seen before, the exact same pattern China used with rare earth elements. And if you studied what happened with rare earths, you know how this story ends. Prices don't just rise, they explode. Supply chains don't just adjust, they panic. And the people who see it coming position themselves very differently than those who dismiss it as distant policy news. Let me walk you through the mechanics of what's actually happening, not the headlines, the structure underneath. Silver sits at a unique intersection. It's simultaneously a precious metal, an industrial commodity, and increasingly a strategic material governments consider critical to national security. The United States officially designated silver as a critical mineral in August 2025. That's not symbolic. That's recognition that certain materials are so essential to economic and defense infrastructure that losing access becomes a national security threat. And here's where China's move becomes surgical. By restricting exports through licensing that only 44 large companies can obtain, they're not banning silver exports outright. They're controlling the valve. They can tighten it gradually. They can adjust based on domestic needs. They can use access as leverage in trade negotiations. This is exactly how they managed rare earths for over a decade, and it worked devastatingly well. Let's talk numbers, because numbers don't lie and they don't care about narratives. Global silver demand in 2025 reached approximately 1.24 billion ounces. Total supply, including mine production and recycling, came in around 1.01 billion ounces. That's a deficit of 230 million ounces in a single year. Not a small gap, not a rounding error. A deficit equivalent to the entire annual silver output of Mexico, which is the world's largest silver producer. And this isn't new. This is the 5th consecutive year of supply deficits. 5 years where consumption exceeded production. 5 years where above-ground inventories were drawn down to fill the gap. And those inventories? They're not infinite. They're approaching critical levels. COMEX registered inventories, the silver actually available for delivery against futures contracts in the United States, have collapsed 70% since 2020. London vaults, traditionally the deepest pool of physical silver globally, have lost around 40% of their holdings. Shanghai inventories hit decade lows. At current consumption rates, some industrial regions are operating with barely 30 to 45 days of accessible silver reserves. Think about that, 30 to 45 days. That's not a comfortable buffer. That's living hand to mouth. And now China, which controls the majority of refining capacity, is implementing export restrictions starting January 1st, 2026. 2 days from now, as I record this, here's where most people misunderstand what's about to happen. They think export restrictions mean prices go up. Simple supply and demand, and yes, that's part of it. But the real impact is structural, not just numerical. When you restrict silver exports through licensing that only large, state-approved companies can obtain, you're not just reducing volume, you're fragmenting the market. Small and medium-sized exporters, the ones who've served as flexible suppliers to global industrial users and refineries for decades, are gone. The relationships, the logistics networks, the flexibility, all eliminated overnight. What replaces them? A handful of large Chinese companies operating under government supervision with government priorities. And those priorities are clear. Serve domestic industrial needs first, export second. Use export access as strategic leverage third. This creates immediate problems for Western manufacturers. Delivery times extend. You used to order silver, get it in 2 weeks. Now you're quoted 6 weeks, 8 weeks, 12 weeks. And those quotes come with conditions. Minimum order sizes increase. pricing becomes less transparent. Long-term contracts replace spot purchasing. For industries dependent on silver, solar panel manufacturers, electronics producers, automotive companies building electric vehicles, this isn't a minor inconvenience. This is supply chain disruption at the foundational level. And here's the part that keeps industrial procurement managers awake at night. Silver isn't easily substitutable. You can't just switch to another metal for most applications without sacrificing performance. Silver has the highest electrical conductivity of any element at room temperature. In solar panels, that matters. In electric vehicle battery management systems, that matters. In advanced electronics and semiconductors, that matters. Engineers have been working on reducing silver content in products for years, and they've made progress. Modern solar panels use less silver per watt than panels from 5 years ago, but the reduction in silver per unit is overwhelmed by the increase in total units produced. Global solar installations exploded in 2024 and 2025. Electric vehicle production continues climbing despite economic headwinds. AI data centers, which require massive amounts of silver in their electrical infrastructure, are being built at unprecedented rates. The math doesn't work in favor of reduced demand. Even with efficiency improvements, total silver consumption keeps rising. Now let's talk about something most silver analysis completely ignores: the byproduct problem. About 75 to 80% of silver production doesn't come from silver mines. It comes as a byproduct of mining for other metals, primarily copper, zinc, and lead. Think about what that means. When you want more silver, you can't just decide to mine more silver. You have to justify mining more copper or zinc or lead. And those markets have their own dynamics, completely unrelated to silver prices. Copper prices are choppy. Zinc prices remain depressed. Lead demand is stable, but not growing. Which means even if silver hits $100 per ounce, mine supply won't respond quickly. The economics of the primary metal the mine was built to extract, determines whether the mine operates. Silver just tags along. And new mines? The timeline for bringing a new silver deposit from discovery through permitting, financing, construction, and into production typically runs 10 to 15 years, a decade minimum. So any silver supply response to today is high prices, won't hit the market until the mid-2030s at the earliest. This is what creates the trap. Demand rising, supply constrained by byproduct economics, inventories depleting, and now the largest refiner and processor in the world implementing export controls. Let me show you what this looks like in the physical market right now, because there's a massive divergence happening that reveals the stress building underneath seemingly calm headline prices. In Shanghai, physical silver is trading above $80 per ounce. In New York, COMEX silver futures trade around $75 per ounce. Wait, what? How can the same commodity trade at radically different prices in different locations? Because they're not really the same thing. COMEX futures are paper contracts, promises to deliver silver at some future date. Shanghai pricing reflects actual physical metal changing hands for immediate delivery. And when physical metal becomes scarce, the premium for actually holding it in your hands rather than holding a promise on paper explodes. This premium tells you everything about market stress. In normal markets, physical silver trades slightly above paper prices to account for fabrication, shipping, and dealer margins. Maybe 2 to 4% premium. When physical premiums hit 100% or more, as they are in some markets right now, that's not normal markup. That's panic pricing. That's industrial users and investors desperate to secure actual metal bidding against each other while paper markets pretend everything is fine. And here's where it gets interesting, or terrifying, depending on your position. Silver lease rates, the cost of borrowing physical silver, spiked to 200% annualized during periods of acute tightness in 2025. That means traders were willing to pay twice the value of silver just to borrow it for a year. Why? Because they had sold silver they didn't have, contracts they couldn't fulfill, and they needed metal immediately to avoid default. This is what a squeeze looks like in real time, not the dramatic Hollywood version. The grinding, persistent, slowly then suddenly version, where each month the system gets a little tighter, a little more stressed, until something breaks. Now here's where China's export restrictions fit into this picture. They're not creating the squeeze was already happening. 5 consecutive years of supply deficits already created the conditions for shortage. What China's doing is accelerating the inevitable. They're tightening the valve on a system already under pressure, and they're doing it deliberately. This isn't accidental policy. This is strategic resource management. China watched the United States weaponize the dollar through sanctions. They watched the West cut Russia off from SWIFT. They learned that in a world of increasing geopolitical tension, control over critical materials provides leverage that military power alone cannot. Silver fits perfectly into this strategy. It's critical for clean energy technology that every government committed to. It's essential for advanced electronics and semiconductors. It's necessary for electric vehicles. And China controls the refining infrastructure that turns raw silver into usable material. By restricting exports now, while domestic Chinese industries are consuming increasing amounts for their own solar installations, EV production, and electronics manufacturing, China ensures their industries don't face shortages while everyone else scrambles. And as an added benefit, they create dependency. If you're a solar panel manufacturer in Europe or a battery producer in the United States and you need silver, you're now dependent on one of 44 Chinese companies approved to export. Companies that can be told at any moment to prioritize domestic needs. This is leverage without firing a shot. This is geopolitical positioning through commodity control. And it works because the alternatives, building new refining capacity outside China, developing new mines, reorganizing supply chains, take years, not months, years. Let's talk about what this means for different groups of people. Because the impact isn't uniform. This creates winners and losers, and the gap between them is enormous. Industrial users, they're the most immediately affected. Solar panel manufacturers already operating on thin margins now face rising input costs and uncertain supply. Can they pass costs to customers? Maybe some. But in competitive global markets, rising costs often mean lost business to competitors who secured better supply contracts earlier. Electric vehicle manufacturers, they're in a similar position. Each EV uses roughly 25 to 50 grams of silver. Doesn't sound like much until you multiply by millions of vehicles, and the supply chain for EV components is already stressed. Adding silver supply uncertainty creates another point of potential failure. Electronics manufacturers, they've been dealing with semiconductor shortages, component availability issues, and now silver supply constraints. For products that require silver in critical applications, where substitution isn't possible, this means longer lead times, higher costs, or both. Investors who understood this pattern early, they're in a different position entirely. Physical silver holders, people who own bars, coins, allocated storage, they're sitting on assets appreciating not just from price increases, but from the increasing premium physical metal commands over paper contracts. Silver mining companies, particularly primary silver producers that aren't dependent on byproduct economics, they benefit from higher prices and increased attention to secure supply. Companies with high-grade deposits in jurisdictions outside China suddenly become strategically valuable. And then there's the group that loses most painfully. People who ignored the warnings, who dismissed silver as just another commodity, who thought paper exposure through ETFs was the same as physical ownership, who assumed markets would always function smoothly. They're about to learn expensive lessons about the difference between claims on silver and actual silver. Here's a question nobody's asking, but everyone should be. What happens when the paper market realizes it can't deliver against contracts? The silver market has always operated on the assumption that most futures contracts get cash settled rather than physically delivered. And historically, that worked. Only a small percentage of contract holders actually stood for delivery, took physical metal. The rest rolled contracts forward or settled in cash. But what happens when that assumption breaks? What happens when industrial users, facing potential supply disruptions, decide they need to secure physical metal through futures contracts? What happens when investors, watching physical premiums explode, decide paper promises aren't good enough? The system isn't designed for everyone to demand delivery simultaneously. It's designed for most people to stay in paper. And when large numbers of contract holders demand physical metal, the available inventory drains fast. We've seen glimpses of this stress already. 60% of COMEX registered silver inventory was claimed for physical delivery within just 4 trading days in late 2025. 4 days. That's not normal market function. That's stress testing the system's capacity to deliver. And here's what's fascinating about timing. China's export restrictions begin January 1st, 2026, 2 days away. The tightest physical silver markets in modern history, the largest supply deficit in recorded data, inventories at multi-decade lows, and now a major policy change that further restricts available supply. If you were designing conditions for a market dislocation, you couldn't script it better. Now, let me address the question everyone's thinking. What about price? Where does silver go from here? I'm not making price predictions, but I can show you what historical patterns suggest and what current fundamentals indicate. Silver currently trades around $74 to $76 per ounce, depending on the day and market. That's already a massive increase from where it started 2025, roughly $30. But here's context. In 1980, silver hit $49.45 per ounce during the Hunt Brothers squeeze. Adjusted for inflation, that's approximately $170 in today's money. We're not even halfway to the inflation-adjusted 1980 peak. Some analysts are calling for silver to reach $100 per ounce by mid-2026, based purely on supply-demand fundamentals. Others, looking at the historical ratio between gold and silver prices, suggest much higher. Gold currently trades above $4,100 per ounce. The historical long-term average ratio between gold and silver is roughly 15 to 1. Currently, it's closer to 56 to 1. If that ratio reverted to just 30 to 1, silver would be $140 per ounce. At historical average of 15 to 1, silver would be $280 per ounce. Are those prices guaranteed? No, markets don't follow neat formulas, but they show the scale of potential revaluation if fundamentals continue deteriorating and physical scarcity becomes undeniable. What matters more than any specific price target is understanding the regime change happening. For decades, silver traded primarily as a financial asset, with industrial demand as steady background noise. That's flipping. Silver is becoming primarily an industrial material with strategic importance, where financial investment amplifies but doesn't drive the core dynamic. In that world, price becomes less about speculation and more about allocation. Who gets access? Who can secure supply? What premium do you pay for certainty? And in a world where China controls export access, where inventories are depleted, where demand keeps rising from non-discretionary sources like solar mandates and EV adoption targets, the answer is increasingly high premiums for increasingly uncertain supply. Let me show you one more pattern that should concern anyone dismissing this as temporary noise. Every time China has implemented export controls on strategic materials, the initial reaction is dismissal. Analysts say it's temporary. Markets assume alternatives will emerge quickly. People believe China needs export revenue too much to maintain restrictions long term. And every time, they're wrong. Rare earth export restrictions implemented in 2010 remain in effect today, evolved and refined, but still controlling market access. Tungsten and antimony, also restricted in recent years, show the same pattern. Initial controls followed by gradual tightening as domestic needs are prioritized. Why would silver be different? China's domestic silver consumption is rising. Solar installations in China are accelerating. EV production in China is massive and growing. Electronics manufacturing, AI infrastructure, industrial applications, all consuming silver domestically. And unlike rare earths, where China dominates mining, silver is mined globally, but refined primarily in China. That refining bottleneck is where control really matters. You can mine silver in Mexico, Peru, Australia, anywhere. But turning that raw material into usable refined silver that meets industrial specifications, that expertise and infrastructure is concentrated in China. And now export of that refined silver is restricted to 44 approved companies. This is a masterclass in strategic resource control. And anyone who thinks this is temporary or unimportant is making the same mistake people made with rare earths 15 years ago. So what do you actually do with this information? Because analysis without application is just entertainment. First, understand what you're protecting against. This isn't about getting rich from silver price gains, though that might happen. This is about preserving purchasing power as currency systems are stress tested and certain physical assets become increasingly difficult to access at any price. Second, understand the difference between paper exposure and physical ownership. ETFs, futures, mining stocks, they all have their place. But when we're discussing structural supply constraints and potential system stress physical metal in your possession or in allocated storage, you control is fundamentally different from claims on metal that may or may not be there when you need it. Third, understand timeline. This isn't a one-month story. The supply deficit has been building for 5 years. The export restrictions begin in 2 days. The impact plays out over months and years as inventories continue depleting and replacement supply proves inadequate. Positioning for this kind of structural shift requires patience and discipline, not trading reflexes. Fourth, understand scale. How much physical silver makes sense varies enormously based on individual circumstances. What I can tell you is that token exposure, holding a few coins as a hedge, probably isn't sufficient given the magnitude of potential disruption. And overconcentration in any single asset creates its own risks. The goal isn't predicting exact outcomes. The goal is positioning for a range of plausible scenarios where physical assets become more valuable relative to paper promises, where supply constraints create sustained price pressure, and where early positioning proves far cheaper than late panic. Let me end with this observation. Market participants tend to ignore structural problems until they become acute. And by the time problems become obvious to everyone, the opportunity to position advantageously is gone. Right now, today, December 30th, 2025, most people aren't paying attention to China's silver export restrictions. They're focused on holiday plans, year-end financial moves, or simply tuned out. The announcement about 44 approved exporters sounds bureaucratic and boring. But underneath that boring announcement is a supply structure that's been fracturing for years, finally reaching the point where policy intersects with physics, where declining inventories meet restricted exports, where rising industrial demand meets constrained supply response. The people who understand this, who take it seriously, who position accordingly, they'll look back on late 2025 as the moment the warning was clear. The moment the path forward became visible, everyone else will look back and wonder why they didn't see it coming, despite all the signals. China named 44 companies approved to export silver. Sounds simple, but that number represents a fundamental restructuring of global silver markets. And the implications of that restructuring are just beginning to play out. The question isn't whether this matters. The question is whether you're positioned for what happens next.